Welcome to the deep dive. Today, we're plunging right into something absolutely central to, well, everything, money and credit.
Mm-hmm. It really governs so much, doesn't it? From the smallest local transaction, like you said, the chaiwala, right up to huge corporate deals.
Exactly. We've got some fascinating sources today that look at this not just as numbers, but as real human stories.
That's the goal, isn't it? To understand the mechanics, sure, but also how credit can be this incredibly powerful force, sometimes for good, sometimes leading to real hardship.
So let's start right at the beginning. It seems obvious, but why do we actually need money? Couldn't we just trade things directly? Barter.
The barter system. Well, the big problem there is what economists call the double coincidence of wants. It sounds complicated, but it's simple, really.
Meaning?
Meaning, if you make shoes and want wheat, you don't just need to find someone selling wheat, you need to find a wheat seller who specifically wants to buy shoes right now.
Ah, okay. That sounds inefficient.
Yeah.
You could spend ages just looking for that perfect match.
Exactly. It severely limits trade.
Uh-huh.
So money steps in as that crucial intermediate thing, a medium of exchange.
It breaks that chain. Sell shoes for money, then use the money to buy wheat or anything else. Simple.
Precisely. And historically, that money took many forms, didn't it? Grains, cattle, especially in early India, then metallic coins, gold, silver, copper, things with some inherent value.
But that brings us to today's money. Paper notes, coins. This stuff isn't gold. It has, as our sources say, no use of its own. So why on earth do we accept it?
That's the fascinating part. We accept it purely because the government authorizes it. Here, the Reserve Bank of India, the RBI, issues currency notes on behalf of the central government.
And the law says you have to accept it, right? If someone owes you money in rupees, you can't refuse payment in rupees.
Exactly. The law legalizes its use. That government backing, that trust is everything for modern currency. It's not about the material, it's about the authorization.
Okay, so that's cash. But there's another huge form of money today. The money in our bank accounts. Demand deposits.
Right. Think about your salary. It gets deposited, right? You don't usually get paid in a suitcase full of cash anymore.
Hopefully not.
So you deposit that money, it's safe, maybe earns a little interest, and crucially, you can withdraw it whenever you need it on demand. Hence the name, demand deposits.
And this allows for transactions without any physical cash changing hands, like checks.
Yes. Let's take that example from our source, M. Salim, the shoe manufacturer. He needs to pay his leather supplier. Instead of cash, he can just write a check.
Which is basically just an instruction to his bank.
Exactly. It's a piece of paper telling his bank, take this specific amount from my account and put it into my supplier's account. The payment happens, no cash involved.
So these demand deposits, facilitated by banks and things like checks, they act just like money. They're part of the money supply in our modern economy.
Absolutely. And of course now it's increasingly digital, isn't it? Computerization, online transfers, payment apps.
Which brings us to that huge event in India demonetization back in November 2016. Remember when the old 500 and 1,000 rupee notes were suddenly declared invalid?
Oh yes, a massive shock to the system. The stated aim was tackling corruption, unaccounted wealth, counterfeit currency.
And one major immediate effect was a huge push towards non-cash transactions, wasn't it?
Definitely. With those notes gone, people scrambled to use bank transfers, debit credit cards, POS machines. Digital payments saw an enormous surge. It fundamentally accelerated that shift away from cash dependency.
So people are depositing money, transactions are happening digitally,
Yeah.
the banks are holding all these deposits. What do they do with all that money? Just keep it safe?
Well, they keep some of it safe and accessible. They have to hold a certain portion as cash, maybe around 15% is what the source mentioned, though it can vary just in case lots of depositors want their money back on the same day.
Only 15%. What about the rest?
Ah, that's the key to banking. The major portion, the other 85%, they use to extend loans.
They lend it out to other people, businesses.
Precisely. Banks act as mediators. They take deposits from people who have surplus funds and lend them to those who need funds for starting a business, buying a house, education, whatever it might be.
And they make money from the difference in interest rates, I assume.
Exactly. They charge borrowers a higher interest rate than they pay depositors. That difference, that spread, is their main source of income.
Okay, so that brings us neatly to the second half of our topic, credit, or loans. Basically an agreement where the lender supplies the borrower with money, goods, or services now in return for the promise of future payment.
Yes, and this promise, it can be the key to unlocking opportunity, or it can become a terrible burden. It really is a double-edged sword. We have two great contrasting stories here.
Let's start with the positive one.
Yeah.
Salim, again, our shoe manufacturer. It's festival season, and he gets a huge order, 3,000 pairs of shoes. Needs to be delivered in a month.
Big opportunity. But he needs money up front for raw materials, extra workers, working capital.
So what does he do? He uses credit. Two kinds.
First, he gets his leather supplier to give him the leather now, with a promise to pay later. That's trade credit.
Okay.
Second, the large trader who placed the big order gives him an advance payment in cash, also as a loan to be deducted from the final payment.
So he gets the materials and the cash he needs through these credit arrangements.
Yeah.
And the outcome.
He meets the order on time, makes a good profit, repays the leather supplier, repays the advance from the trader. Everyone's happy.
So here, credit played a vital positive role. It allowed him to expand production, meet demand, and increase his income. Fantastic.
A clear success story. But now let's look the other side. Swapna's problem.
Right. Swapna is a small farmer cultivating groundnuts on her 3 acres of land. She takes a loan from a local moneylender to cover the costs: seeds, fertilizer, water.
She's hoping for a good harvest to repay the loan and make a profit. It's a gamble. Farming always is.
And in her case,
Disaster strikes. Her crops are hit by pests. She tries using expensive pesticides, but it doesn't save the crop. The harvest fails.
oh no. So she can't repay the moneylender?
Not only can she not repay, but the interest keeps adding up. The debt grows over the year into a large, unmanageable amount.
What happens then?
She's forced to sell a part of her land to clear the debt. Instead of improving her situation, the credit actually made her worse off. She lost a valuable asset.
That's the debt trap we hear about.
Exactly. It's a situation where credit, instead of helping, pushes the borrower into a cycle of debt that's incredibly difficult, sometimes impossible to escape. Recovery is very painful.
So the usefulness of credit really depends, doesn't it, on the situation, the risks involved.
And crucially, whether there's any support if things go wrong. For Salim, the business risk paid off. For Swapna, the agricultural risk led to ruin, and the credit amplified that disaster.
This brings us to the nitty-gritty, the terms of credit. What exactly does that involve?
It's basically the set of conditions under which a loan is given. It includes several key things.
Like the interest rate, obviously.
Yes, the interest rate the borrower has to pay. Then there's the documentation required, the mode of repayment, how long you have to pay it back, whether it's in installments, lump sum, etc.
And the big one you mentioned earlier, collateral.
Ah, yes, collateral. This is really important. Collateral is an asset that the borrower owns, like land, a building, vehicle, livestock, even deposits with banks that they pledge to the lender as a guarantee until the loan is repaid.
A guarantee, meaning if the borrower fails to repay.
The lender has the right to sell that asset, the collateral, to recover the loan amount. It reduces the lender's risk significantly.
Okay, so these terms, interest rate, collateral, documentation, repayment, they can vary hugely, can't they?
Massively. And this variation often depends on who is lending and who is borrowing. Our sources give some really stark examples from a village called Sonpur.
Right, let's look at those. First, there's Rama. She's a landless agricultural laborer. She often needs small loans for sudden expenses like illness or just daily needs when there's no work.
And where does she borrow from? Her employer, the landowner she works for.
Okay, and the terms?
The interest rate is, well, it's 5% per month.
Per month. Wait, that's 60% per year.
60%, yes. Plus, she has to work for the landowner to repay the loan. Often, because her wages are low and expenses continue, she ends up taking a fresh loan before the old one is paid off. Her debt keeps growing.
That sounds very much like Swapna's debt trap, just through labor instead of land loss initially.
Oh.
Okay, who else is in Sonpur?
There's Shamal. He's a small farmer with a few acres. He needs loans for cultivation, too. He borrows from a large village trader.
Is his interest rate any better?
A bit. Maybe 3% per month. Compared to, say, banks.
But is there a catch?
Oh, yes. The trader adds a condition. Shamal must promise to sell his entire crop to the trader after the harvest.
So the trader gets the crop cheap, right when prices are lowest, because Shamal is first to sell to him.
Exactly. The trader profits twice from the high interest and from buying the crop at a low price and likely selling it later when prices rise. It's a hidden cost for Shamal.
Okay, so Rama and Shamal are stuck with high-cost, exploitative, informal loans. Is there anyone getting a better deal?
Yes. Meet Arun. He's a farmer with more land, maybe 7 acres. He has documents. He has assets. He accesses credit from a different source altogether.
A bank.
A bank. He gets a loan for his farming needs at an interest rate of just 8.5% per year.
8.5% per year. Compare that to Rama's 60%.
Huge difference, and his repayment terms are much more manageable. He can repay any time over the next 3 years. He even has the option later of using his warehouse receipt for stored potatoes as collateral for a fresh loan from the bank if needed.
So for Arun, credit is cheap, flexible, and helps him manage his farm and potentially increase his income by selling his crop when prices are better.
Precisely. The contrast between Arun and Rama and Shaimal is stark. It highlights the two major sectors of credit.
The formal sector and the informal sector.
Exactly. The formal sector includes banks and cooperatives. They are supervised by the Reserve Bank of India. Their interest rates are generally much lower and regulated.
Like Arun's 8.5%.
Right. Then there's the informal sector. This includes moneylenders, traders, employers, relatives, friends. There's no organization supervising them.
Like Rama's employer charging 60%, or Shimal's trader at 36%, plus the crop condition.
And they can use whatever methods they want to get their money back. The interest rates are often sky high, and the terms can be incredibly harsh.
And the data shows who relies on which sector, doesn't it?
It does, and it's quite revealing. In urban areas, for example, richer households get something like 85–90% of their credit from formal sources, banks.
While poorer households.
Poorer households in urban areas rely much more heavily on informal sources. Our source suggested over half, maybe 53% of their loans come from informal lenders.
So the poor, who arguably need credit the most just to get by or maybe start a tiny business, are paying vastly higher interest rates than the rich.
That's the painful irony. Formal lenders like banks are often hesitant to lend to the poor, mainly because of that collateral issue.
Right. If you don't have land or property or regular employment documentation, it's hard to get a bank loan.
It is. Banks need that security. Informal lenders, on the other hand, often know the borrowers personally, maybe live in the same village. They understand the local context and are often willing to lend without collateral.
But at a terrible price. High interest, potential harassment.
Exactly. So the lack of access to affordable formal credit is a huge barrier for the poor. How do we overcome this?
Is there a solution?
Well, one really interesting and successful approach that emerged, particularly in rural areas, is the self-help group, or SHG.
Self-help groups. Tell us about those.
The basic idea is to get the rural poor, especially women, to organize themselves into small groups, typically 15 to 20 members.
Okay. And what do?
They start by pooling their own savings, even small amounts, regularly, maybe 25 rupees, 50 rupees, 100 rupees or more, whatever they can manage per member, collected frequently.
So they build up a small collective fund first.
Yes. They create their own little pool of capital through regular saving. This builds financial discipline and group cohesion.
And then does that help them get bigger loans?
It's the crucial stepping stone. Once the group has been saving regularly for a year or two, it becomes eligible to apply for a loan from a formal bank.
But the loan isn't given to an individual member.
No, this is the key innovation. The loan is given in the name of the group.
The whole group takes out the loan.
Yes. The group decides who among its members gets smaller loans from this main loan amount, what purpose the loan is for, the interest rate, which is usually low, the repayment schedule.
And importantly, who is responsible for repayment?
The group is collectively responsible. If one member defaults, the entire group is under pressure to ensure the loan is repaid. This peer pressure, this collective responsibility, acts as a powerful substitute for physical collateral.
That's clever. The bank is lending based on the group's track record of saving and their mutual accountability, not on individual assets.
Precisely. It overcomes that major hurdle, the lack of collateral, that prevents so many poor individuals from accessing formal credit. It helps build creditworthiness from the ground up.
And it empowers the members, particularly women, to make collective financial decisions.
Absolutely. These SHGs have become engines for empowering women, promoting small income-generating activities, and improving livelihoods in countless villages.
Is this just an Indian phenomenon?
Oh, no. Variations of this model exist globally. The most famous example is probably the Grameen Bank of Bangladesh, founded by Professor Muhammad Yunus.
He won the Nobel Peace Prize for that, didn't he?
He did in 2006. Grameen Bank pioneered lending small amounts microcredit primarily to poor women based on group liability. Its massive success demonstrated to the world that the poor are indeed reliable borrowers, especially women, and that providing them access to credit on reasonable terms can be a powerful tool for poverty reduction.
So wrapping this up, our deep dive really shows money as the facilitator, the essential tool for exchange backed by government trusts.
But credit. Credit is where the real drama lies. It can be the engine of growth, like for Salim, enabling profit and expansion.
Or it can be the trap that drags people down, like Swapna and Rama, especially when the terms are harsh and there's no safety net.
And access to cheap, affordable credit, particularly formal credit, is absolutely crucial for development, especially in rural areas where informal lending often dominates.
The difference between success and struggle so often comes down to those terms of credit. And the SHG model shows that social innovation, organizing people collectively, can actually solve fundamental problems like the lack of collateral.
It proves that trust and collective accountability can be just as powerful, maybe even more powerful than physical assets as a basis for lending.
Which leaves us with a final thought for you, our listener. The Grameen Bank and the SHGs found immense success by shifting the focus from individual assets to community trust and group guarantees. If that principle were applied more broadly, how much faster could economic development really proceed if the entire financial system placed a bit less emphasis on traditional collateral and a bit more on understanding and leveraging the power of collective reliability and community guarantees? Something to think about.